Hello, I'm Jim Lebenthal, the Chief Market Strategist at Cerity Partners and a member of our investment committee. This is our outlook on the financial markets and economy for the month of March 2026. We're already 2 months into the year and it has been very volatile, perhaps uncomfortably so. I know many of you listening are worried about the state of the financial markets, and I'm here to give you some good news. Now, first off, the returns so far throughout most of the financial markets really aren't that bad. The S&P 500, for example, is up 1.5% year to date. International markets are much higher than that, with international developed markets up about 10%. And even within the U.S. markets, there are many sectors that are doing quite well, as measured, for instance, by the equal weight S&P 500, a measure of the average stock, which is up about 6% year to date. So why are people so concerned, and why do they feel like maybe the returns have been worse than what I just suggested? I think the answer has to do with the fact that many of the stocks that have been the leaders over the past 3.5 years are turning in kind of lackluster performances this year. So for investors to see that their beloved Microsofts, Amazon, and Metas are down on the year is startling. And some of the real high flyers from last year, like a Palantir or an AppLovin, are well off of their highs. So some of the more popular stocks really have had a tough start to the year, and I think that is making people concerned about the markets overall. But as I said, the markets are actually in good shape. And it's not just equities. Fixed income, depending on which index you look at, is up anywhere from 1% to 2% just 2 months into the year. That's not bad. What are the fundamental causes for concern, though, that people are citing when they look at the markets? There are really two. The first is the concern that artificial intelligence may be a bubble imminently popping. And the second is that if artificial intelligence isn't a bubble, that maybe it's simply going to eat every other industry's lunch and leave no profits for any companies outside of the artificial intelligence world. Let's discuss those two possibilities. Starting with, is artificial intelligence a bubble? We don't think so. If we look, for instance, at the spending plans that have been announced by the major hyperscaling companies, and by those we include Amazon, Alphabet, Microsoft, and Meta, those plans are almost $700 billion of spending on capital expenditures this year. That is not the sign of an industry that is a bubble popping. That is a meaningful increase over 2025 or any of the years prior to this year. And importantly, that spending appears to be profitable. If you listen to the CEOs of Amazon, for instance, or OpenAI or NVIDIA, they all say that every gigawatt of compute that they bring online is profitable in the instance that they bring it online. That is not the sign of a bubble. Finally, on this bubble comment, many people have been worried about the financing for these capital expenditures. I do want to point out that those top 4 hyperscalers that I mentioned currently have a net debt position that is negative, meaning if you combine all of their balance sheets together, they have more cash than debt. Now, it is absolutely true that they will be spending more than their free cash flow this year in order to build out those data centers that we hear so much about. And so those debt levels will have to increase, maybe by a few $100 billion. And that number may catch you by surprise. It may make you worry a little bit. But do bear in mind that those top 4 companies have a combined equity market capitalization well above $10 trillion. Bluntly speaking, those few $100 billion of debt financing are a drop in the bucket by comparison. So we don't think that artificial intelligence is a bubble. But what about the other scenario? What about this somewhat Malthusian scenario that artificial intelligence not only takes over the profits of every industry, but also ruins the job market, putting people out of work? There was a research piece recently from a company called Citrini that played this scenario out. It was a thought experiment, but it really roiled the markets by projecting 2 years from now a somewhat dystopian environment in which unemployment had shot to 10%, people couldn't get any work, companies outside of artificial intelligence had been disenfranchised. It was a very, very dire scenario. I do want to point out that history has shown whenever there is a disruptive technology, humankind at first gets very worried, but then adapts to it. And we've seen this over the last 28 years or so. I use that time frame because in 1998, I was on the floor of the New York Stock Exchange. There were over 5,000 people on the floor of the stock exchange with me. Traders, brokers, runners, clerks. It was chaos. Now, I go to the New York Stock Exchange 2 or 3 times a week, and there are literally 300 people on the floor of the exchange. So there has been job destruction, primarily from the advent of the digital age over the last 3 decades. But that digital age has made things more efficient, including price discovery in the financial markets. And as that has gone on, employment in the finance industry overall has gone up by about 20%, from 5.7 million at the turn of the century to about 6.8 right now. That is what creative destruction is like. That's what happens when a revolutionary technology comes along. Jobs are destroyed, but new jobs are created. And if you think back over the last 25 years, the U.S. population has grown by 60 million people, a good 20%. And yet the unemployment rate today is 4.3%, which is extraordinarily low. So these fears of a Malthusian dearth, in the 19th century, it was a worry about a dearth of food, versus now the destruction of jobs, are quite likely to be misplaced fears if history is any guide. Humankind always adapts, and that's what we expect will happen in the technology space going forward. I look forward to updating you as the months of this year progress. Thank you for listening.